Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to hit up where I might think we are in the cycle. And I'll give you some data, give you some statistics, and maybe you guys can decide where we are in the cycle as well, given the data, or where your best guess is. So what we're going to talk about is the real estate cycle, where we're at in it. And the reason that is so important is because new housing construction drives credit expansion, and that ultimately drives interest rates, which ultimately drives the rotation of money in and out of stocks, bonds, and other assets. It's out of some of those assets and into other assets. So that's why it's so important. That is really what drives asset rotation. And to know where we are in the cycle kind of is the cheat code. The cheat code in the back, it's the ABBA select start to winning the game, so to speak. It's the cheat code. And what I'm going to do is I'm going to look at a couple of different things. We can look at yields. We can look at the dollar. We've got some information. Just kind of, I'll talk off the cuff here about the real estate starts, what the housing market, the deficits that people are projected, and a little bit of inventory. And all of that should paint a picture of kind of where we're at. It won't give us the precise 100% or 95% confidence level of exactly pinpointing where we're at, but it gives us an idea that, we're either early, middle, or late in the expansionary phase. And obviously, I have my opinions, and other people are going to disagree with this. It seems like there's a vast difference in opinions on this topic. The topic of, are we in a housing bubble? Are we not in a housing bubble? And there's a vast difference in the opinions on a lot to do around affordability and why that matters or doesn't matter. So let's dive in. Let's go into what I've got here. And again, guys, if you like this type of analysis, if you want to know individual companies, you can obviously look at finding-value.com and sign up there. You still have the happy birthday discount code going on as well to get you 50% off the first month to try it out if you'd like. So let's dive in and take a look. I'm going to start with the DXY. I've got the DXY here, and I've got gold on the bottom. Gold is a good indication of if we're in a commodity bull market or not. The reason I say that is credit expands in commodity bull markets. Credit comes from loan creation against new homes. And generally what happens, and this is my interpretation of the data when I look back, it's not a book that told me this, it's me looking at data and how I kind of interpret it. The DXY moves up and down, a lot of it, not all of it, but a lot of it based off of interest rates. The monetary tightness of one currency versus a monetary tightness of another currency. And generally what we see is in a credit expansion phase, it seems like the dollar strengthens in the beginning of the rate hike cycles. So when we look back in the 90s, we had a rate hike cycle, coming up, and maybe I can do like the Fed funds or something like that underneath. And you can kind of see that the cycle kind of goes up, and that's kind of the dollar going up. And then when the rate hike cycle kind of ends, that's when the dollar starts to fall. So we see a decline from 2000 onward. We see a decline in rates all the way down to 2004. We saw the dollar fall roughly in that same time frame. We also saw the dollar fall, again, guys, this isn't a perfect correlation, but we saw an increase coming up here. We had an increase in the dollar come back up, and then the dollar fell again, and then they kept rates sideways, and then they lowered rates. And I think a lot of this also deals with, I think the DXY is almost front running some things as well. It's the anticipation of looser monetary conditions. So the dollar right now, if we were to look, the bottom of the ratio was in 2020 here, and we had an increasing interest rate environment, or I should say no, we had a DXY going up from 2008 It was going up, going up, going up. Then we had the increase in the Fed funds rate from 2015 onward all the way to the peak of 2019. And you can see that increase a little bit in the DXY here. Then we had a decline in 2019, 2020. Everybody ran to the dollar, brought it back down. And then we had another increase in the DXY and an increase in rates. But recently we've turned and we're heading lower in the DXY. We've basically broken out of support. It's heading lower and we could see lower DXY. That also occurred in 2002, where we broke down on the dollar. We were heading lower. I know some people think that we are in the 2003 timeframe uh, of the commodity bull market, of the last bull market. And when analyzing the DXY, I would say that's probably a fair comparison of 0203 of where we are today. So one could make an argument that we're close to an '03 type era. In '03, we saw rates climb all the way up to 2000, 2001, and then we dropped after that in '01. So one could conclude that we're not even to '01 yet based off of the hiking cycle, because we haven't, well, I don't think we've ended the Fed funds rate hiking cycle yet. So one could conclude that we're not there yet. We're still a little bit earlier than 2003 when looking at this type of data. And I've got the Fed funds on the bottom, I've got gold in the middle, and I've got the DXY up top. If you look at the 2-year yield, just kind of looking and seeing what yields are doing, and I'll get rid of this to amplify what's going on here. The 2-year yield, you can see that this is cycled basically downward, and we've got these cyclical movements within the big secular trend. That secular trend ended in 2022. But the last bull market, we can see that in 2000, we had interest rates decline all the way kind of coming back down and bottomed in '03. So from an interest rate perspective, at least the 2-year, I don't think '03 is the right time frame to compare to today, because right now we've come from a bottom and we've rocket launched higher. I think that we are still pretty early in this mix, and I think we're more like in '99, where the bull market hasn't even really gained a ton of footing in commodities yet, based off of yields. So what I think has occurred is that we had a large impulse of inflation hit us. It was housing market driven and stimulus driven combined. And I think interest rates, he ratcheted interest rates up really quickly to basically slow down the housing market, slow everything down, which is successful at this time. But we're not at '03 from a yields perspective, because '03 we were bottoming and coming back up. So what happened here, and here's my opinion on it, is we strengthened, and the housing market was pretty much stable during this time frame. So if we were to look at the inventory levels in 98, 2000, 99, 2000, we were stable at a 4-month inventory level, which is slightly positive, or slightly a seller's market in real estate during that time frame. And during that time frame, they started loaning, and we built a bunch of homes, and that all went to inventory. And you can see the rapid increase in inventory in '06, '07, '08, '09. So we had a rapid increase in inventory. That is basically what happened here from '03 all the way to '06. They raised rates, and at that same time, we saw the increase in inventory happening. So a lot of those homes were being built. If you look at housing starts, we had a lot of homes being built during that time frame of '05, '06, '07, '08. A whole bunch of monthly supply of new homes came on the market, and that market couldn't absorb those homes. They went to existing inventory. That is why interest rates peaked out, and they're like, crap, we've got a huge bubble. and then interest rates fell in '07 before the crash in '08. So interest rates generally, they fall rapidly late in the cycle. And in that cycle, generally what you have is you get a bunch of inventory of homes. That's what this is here. You have a bunch of inventory of existing remaining inventory of homes. You can see all these bubbles here, 70s, the early 80s. This is 1990, 91, and this is also. So this is before that is the bubble break, and then your inventories go up at the same time that the bubble kind of pops. So we have all that, and these interest rates follow those, basically the existing real estate inventory levels. Right now, we're at a very low level, and interest rates are at a very elevated level too. We've broken the downtrend line, so this on the right-hand side is different than anything before this, going all the way back into the 80s, because we're in an increasing interest rate environment. We're not in a declining interest rate environment. So right now, looking at rates, you can see that we're kind of going back and forth here. I don't know if this is a peaking top where we are going to rocket going lower, or if rates are going to continue to increase. If rates go lower, I would say, given where the inventory level is today, which we're at a very low inventory level, I would say that's more like 2000s, like the early 2000s, 2000. And then if interest rates come back down, we could see this come back down. And if the inventory levels don't go up on the real estate market, the interest rates are probably coming down for a different reason than the real estate market, which then makes me think that we are in the 2000s timeframe. We are earlier than what most people think. We could have a recession or a slowdown, not driven by the real estate market. We get interest rates to fall. Gold takes off like it always does in that type of environment, and we cycle back down with the real estate market being kind of tight. Interest rates fall just like they did in 2000 and bottom in '03. Then the housing market kicks back on because those rates have fallen. The affordability is good, and we go back into another boom cycle. Um, much like I would say, much like the early 2000s. That is a possibility. But the demographic, the shortage in the housing market, we are supposedly about 6.5 million homes deficit in relationship to household formation. That that doesn't really jive with the way that looks. So I don't think it's going to be a big pullback. I think if we we're going to get one, it could pull back to here. And it would do a retest type move, and then we would get a launch higher. The time frame, it might be a year or two as that comes back down, and then we go on up. What's going to drive that is a flushing out of bad debt or something in the system, which is possible. I'm not saying that's my prediction. I'm just saying it is possible for that to happen, where we come back down somewhere in here. Then as the interest rates fall, inflation kicks up from credit expansion, new homes get sold, the housing market takes off again, and then we come back to the upside. It's a possibility. But with the deficits and the existing inventories being so low, another possibility is that we come back to the bottom here, and then we go back up again. And the way that Powell is basically handling this is he's keeping rates at a high level to keep everything slow. He's slowing down the credit expansion. He's slowing down the inflation in the system. And that's how he's doing it. So I'm not 100% sure on what Powell's next move is. Now, I know other people say, well, he's signaling that he's going to hold rates high or he's going to keep increasing interest rates. That could be the case. I just don't know. I mean, he said he was going to keep rates low all the way into 2024. He said he wasn't going to raise rates, but here we are before 2024, and rates have moonshot on him. He couldn't hold them. Everybody sold them because of the inflation. So I don't know how much control he has over it. We'll have to wait and see. But from that perspective, I think we're earlier than what we are in than the 03, 04 timeframe. Another reason I think we're also somewhat early is we can look at the TYX TNX ratio. This is another ratio. If we kind of back way out, it's highly correlated to gold, and this kind of just cycles up and down, and it's getting more and more. How can I say this? It's the amplitude of these moves are getting larger and larger. The boom and bust cycles are getting somewhat bigger as we go on. What I think, if we look at this cycle here, we've come back down, and we're at a very low level, much like the early 2000s on terms of where we are on this ratio. But you could also argue that the early 2000s was 2018, and that we entered a early cycle here, that we've come on up, we've pulled on back, and that this here is actually more like this here. But it's difficult to say if you're because we're comparing this ratio, and this ratio doesn't mean that we're exactly in that cycle. It is a function of where we are in the cycle, because interest rates and inflation are what are moving this curve. So, when I look at this, I look at where we're at, I look at the housing inventory, I get there's mixed signals of where we are in this cycle. Because I don't know if inflation caused the majority of this little move here. I mean, that could just be a stimulus bump. And the actual commodity cycle and real estate cycle hasn't even hit full force yet. But it's causing an impact on the cycle in the expansionary phase of real estate. So what I can tell you is the houses haven't been built, uh, and we haven't oversupplied the market yet, which would signal the end of the cycle. That hasn't happened or occurred yet. We can keep going in. And the reason I say that hasn't occurred yet is because we don't have the supply or the inventory uh, of homes. Now, I know a lot of people say, well, look at the monthly supply of new homes here. It's really high. Yeah, but we do not have existing home inventory. Existing home inventory is incredibly low. I'm wondering if I have a existing home inventory level that is more recent in these charts. I don't actually have one. Oh, yes, I do. We're way down in like no man's land. We're below this. We're at like 2 months of inventory, 3 months of inventory. We're down here. All right. We're way down there in terms of inventory. And that does not signal a hyper supply phase, which is the end of the commodity bull market when we're down here. So that's kind of what I'm seeing in the markets. So to sum this all up, and when I look at all this, and even looking where gold's at, um, gold in 2002 had broken out of this pattern here, and we've just broken out of the highs here. I mean, one could conclude maybe that we're at like early 2000s. That's early 2000s. But this cycle may last longer than the 2000 cycle because we have more of a shortage in the real estate market. So that is what I'm seeing in the market is I think we're earlier than what some people think. Now, obviously, people are going to disagree with me. They're going to say um, that we're in a housing bubble and that the homes just need to come into inventory. But that generally takes a long time. It's not going to be a month or two. Generally takes a year or two or three to fill back the inventory. So I don't think we're at a crash level yet, and I think it's going to take some time for the inventory levels to refill. And that generally occurs from new homes being built. And it depends on how fast we build them and what the affordability is and all, et cetera, et cetera. That it fills the inventory back up. So if I were to make my best guess, I think we're early 2000s, like 02, 01 or something like that, if I were to take a guess. I think there's a lot of appreciation in commodities that can occur. We can also look at the commodity stock ratio. Each time these peaked out, we had a high inventory of existing homes. So if we were to look at 74, 75, we were to look at like 80 before this fell, 1990-ish and 2008-ish, you can see 74, 75 high inventory, early 80s high inventory, early 90s high inventory, and 2008 high inventory. Your commodity to stock ratio peaks at the end of your real estate cycle. And that is where I don't think we're there yet. We don't have the inventory like we have here. We are actually down here. So I don't think that's a possibility that the commodity bull market is done because we don't have the credit expansion ending from the real estate cycle. It's still all in play. The commodity stock ratio is still incredibly cheap. If you look at any of these ratios, we are still incredibly cheap, off the page cheap, and we haven't made our bull run yet. And that's in everything that I look at. Gold, M2, platinum, doesn't really matter. Silver. Platinum's generally an early runner too, so I don't even think we've started the bull market um, with platinum being as low as it is. So one could say we're in early 2000s. And I think that very much is the case. So that is what I've got on the market here. And that's kind of where I think we're at. Let me know what you guys think in the comments section of where we are in this bull market in the real estate cycle for commodities. I generally think that the commodity bull market is run by a credit expansion phase. And then the supply side that's all jacked up is going to amplify this move. So we've got credit coming into the system, same time that supply is limited or constrained. So early 2000s, my best guess is where we're at. I think that we are in the bear trap for commodities. I think we are in the bull trap for stocks. So that's where I think we're at. That would put us 01, 02, 03, somewhere in there, depending on where we are and if the bear trap is done or if the bull trap is done. I don't think it is, but I think that's where we're at. All right, guys, give me a thumb up, subscribe to the channel, subscribe to the website if you'd like. And that's what I've got for today. So we'll catch you next time. This is Finding Value.